If you've done any sort of research on topics like best investments for stock market beginners or best long-term investments, chances are you've heard multiple references being made to index funds. The term index fund is thrown around quite a lot in the finfluencer space, and oftentimes it's a throwaway recommendation for stock market newcomers. And while yes, index funds are certainly an accessible and attractive investment for the average investor, it's important, like with all investments, that you fully understand what it is you're putting your money into. From talking to various people on Instagram, YouTube, and TikTok, it's quite clear that people have heard of index funds, but they aren't totally sure what they are. So let's fix that in today's video. How's it going, everyone? My name is Dan, but you can call me Malone, and today we're discussing index funds. Now, this is a very important video for both stock market newcomers and investing veterans alike, because at the end of the day, most long-term investing strategies involve some form of bedrock investment in an index fund. And as we'll discuss in detail later on in the video, the logic behind this really is embedded in diversification, managing your exposure to risk, and obtaining the returns of the broader market. So what we're going to do today is as follows. First, I'm going to explain what exactly a stock market index is, because you won't be able to fully understand what an index fund is until you actually understand what a stock market index is. Second, we're going to take a look at some of the popular stock market indices which are referenced quite often in the news and articles online. We'll also look at some of the indices which exist on our very own Irish Stock Exchange, as well as some facts about the Irish Stock Exchange that most people aren't aware of. Finally, I'm going to explain what an index fund is and the reasons why you'd want to invest in one. But make sure you stick around until the end of the video, because I'm also going to be explaining the primary difference between index funds and exchange traded funds, aka ETFs, as this is generally a source of confusion for a lot of investors. So if that all sounds good to you, before we begin, can I ask you to please leave a like on the video. By leaving a like on the video, you're playing your part in spreading the word about the importance of financial education, so thanks in advance for doing that. And if you are new around here, consider hitting that red subscribe button below and joining our community of financial enthusiasts. We make financial education videos on this channel aimed at making conversations like these more of a cultural norm. So without further ado, let's get started. So as I mentioned a second ago, you need to understand what a stock market index is before trying to understand what an index fund is. The word index might seem abstract in the context of investing and the stock market, so it's best to actually define what the word index means in the first place. The word index has two primary meanings in the English language, and the one that's relevant to us is a sign or measure of something. So logically, based on the definition of the word index, we can assume that a stock market index is a measure of the stock market, because remember, the word index means a sign or measure of something. Now, what do I mean when I say a measure of the stock market? Well, effectively, this measure is used by investors like me and you to assess how well or poorly the stock market is performing as a whole. When we look at this measure, we're taking account of all the different stocks in the stock market and whether they're increasing or decreasing in value. This gives us a complete picture of the health of the stock market. That's pretty much the main thing you need to know about a stock market index. Now, we have to take this one step further and realize that there's more than one stock market index out there, and that the plural of the word index is indices. So you can have one stock market index which exists alongside many different stock market indices. Now, I know what you're thinking, Malone, what's the point in having more than one stock market index? Isn't there just one stock market? The reason why there's multiple different stock market indices out there is because they all seek to measure a different part of the stock market. The stock market is a very large place. So for example, if you wanted to see how Irish stocks were performing as a whole, it would be very difficult to get any sort of certainty or accurate reading by looking at an index which measured the entire stock market rather than just the Irish stock market. Most of you have probably sat down and watched a news report about one of the many different stock market indices which exist worldwide without even knowing. Ask yourself, can you remember hearing words like Dow Jones, S&P 500 and NASDAQ on the news? If so, these are all different types of stock market indices which seek to measure a different part of the stock market. Let's quickly go through some of the most popular indices which are referenced in the news and articles online. The Dow Jones Industrial Average, aka the Dow, is an index which measures the stock performance of 30 large companies listed on the New York Stock Exchange and the NASDAQ. The S&P 500, aka the S&P, is an index which measures the stock performance of the 500 largest companies in the United States. The Nasdaq is a slightly trickier one because it refers to two separate things. The Nasdaq, which stands for National Association of Securities Dealers Automated Quotations, is an electronic stock exchange in New York where most technology stocks are traded. This is comparable to other stock exchanges such as the New York Stock Exchange, the London Stock Exchange, and the Irish Stock Exchange. And just to clarify, stock exchanges are just places where traders can buy and sell stocks, bonds, and other financial instruments. But the Nasdaq also refers to the Nasdaq Composite, which is an index that measures the stock performance of thousands of different stocks listed on the Nasdaq Stock Exchange. Now, these are all examples of indices which measure parts of the US Stock Exchange, and we're most familiar with these indices because they get the most media attention. But there are plenty of indices which exist outside of the US. The FTSE 100, aka the FTSE, is an index which measures the stock performance of the 100 largest companies listed on the London Stock Exchange. The DAX is an index which measures the stock market performance of the 30 largest companies listed on the Frankfurt Stock Exchange. The NIKKEI 225 is an index which measures the stock performance of the 225 largest companies listed on the Tokyo Stock Exchange. Now, while all of these international indices are definitely important, I'm of the opinion that it's critical that you understand the indices which are native to your own country. And for me, that's Ireland. In Ireland, the main index is known as the ISIC, and it measures the stock performance of all the different stocks listed on the Irish Stock Exchange. There's also variants of this index such as the ISIC 20, which measures the stock performance of the top 20 companies listed on the Irish Stock Exchange. Did you know that the Irish Stock Exchange is actually broken up into 3 separate markets? The first is known as the Main Securities Market, or MSM, and this is where the likes of Ryanair, CRH, and AIB will be listed. Next, there's the Enterprise Securities Market, or ESM, and this is actually a dedicated market for growth stocks. And lastly, there's the Global Exchange Market, or GEM, which is a specialized debt market for professional investors. So those are some of the main indices which exist both domestically here in Ireland and worldwide, as well as some facts you might not have known about the Irish Stock Exchange. Just to clarify, when I say that an index measures the stock performance of the largest or top companies listed on a particular stock exchange, what that means is that the stocks included within the index or measure are going to be the largest companies by market capitalization, aka market cap. Market cap for the purposes of indices is effectively just the total value of the company as determined by the stock market, and is calculated by taking the share price of the company and multiplying it by the number of floating shares. Floating shares are just the shares that are available for trading and exclude any locked up or closely held shares from the calculation. So that was probably a lot to take in, but that's virtually everything you'll need to know when it comes to stock market indices. This is the level of detail that you need to be willing to take on board in order to achieve true financial literacy. It's just not possible to get there with 30 to 60 second clips alone. But now that we've gotten the nitty gritty out of the way, we can move on to the fun stuff and start talking about index funds. So based on what we've discussed so far, what exactly is an index fund? To answer this question, we need to first define what a fund is. When we hear the word fund in the context of investing and the stock market, what we're really talking about is an investment fund. An investment fund is just a pool of money gathered from lots of different investors and used to invest in stocks, bonds, and other financial assets. The idea is that the fund will have more collective buying power than any one investor would have individually. The investors in the fund will own a percentage of the fund's assets based on the number of shares that they hold in the fund. That's a very important point to understand. Just like how you go out and buy a share in a company in order to be entitled to receive dividend payments and benefit from increases in the share price, you would also buy shares in an investment fund for the same reasons. So therefore, an index fund is a pool of money gathered from lots of different investors and used to purchase shares in companies which are measured by a particular index. The goal here is that the returns of the fund will mirror the performance of the index. So for example, if the S&P 500 index sees an increase in stock performance of 2% on a particular day, then index funds which track the S&P 500 index will also see returns of 2%. The important thing to remember, and I see investors make this mistake all the time, is that you can't invest in an index, but you can invest in a fund which tracks an index. The primary benefit of investing in index funds is that you can own a large number of different investments by simply buying one share in the fund. This comes back to the idea of the collective buying power of investment funds. It's far more feasible for the average investor to purchase one share in a fund which tracks the S&P 500 index than it is for that same investor to go out and buy one share in each company which makes up the index. To do so will be very costly. This allows the average investor to gain easy access to diversification, which inherently reduces the likelihood of suffering a major investment loss. That's why index funds are said to provide investors with the market return, due to the fact that the indices themselves typically track a large number of highly valuable companies, which can be said to be representative of the market as a whole. One of the most common areas of difficulty that investors have, especially when starting out in investing for the first time, is differentiating between index funds and exchange traded funds, aka ETFs. The fact of the matter, however, is that this is the wrong question to ask. The correct question is actually what's the difference between ETFs and mutual funds. Up until this point, we've discussed index funds as an investment vehicle that you can invest into. The reality, however, is that an index fund is just a particular type of mutual fund or ETF. So to invest in an index fund, you must purchase a share in either a mutual fund or an ETF. So what's the difference? Both of these investments seek to invest a pool of money gathered from lots of different investors into a selection of stocks, bonds, and other financial assets. However, unlike mutual funds, shares in ETFs can actually be purchased directly from the stock exchange, similar to how you might buy a share in a company. To invest in a mutual fund, you must purchase a share directly from the investment manager who manages the fund. This is best illustrated through an example. Let's say we want to invest in an index fund which tracks the S&P 500 index. If we go the mutual fund route, we can buy a share in the likes of VFIAX, which is the Vanguard 500 index fund. If we go the ETF route, we can buy a share in the likes of VUSA, which is the Vanguard S&P 500 UCITS ETF. Both of these options are index funds, they are simply structured differently. The other two key differentiators between the two are that mutual funds typically have a minimum investment amount and are priced once every day by reference to the net asset value or NAV of the fund. Contrast this to ETFs, which have no minimum investment amount and are priced consistently throughout the day by virtue of traders buying and selling shares in the ETF. Both of these investment types are known as passive investments and typically have low costs associated with investing in the fund. ETFs and mutual funds are not restricted to tracking popular indices, and there's plenty of funds out there which specialize in different sectors, asset classes, and company sizes. That's mostly everything you'll need to know when it comes to stock market indices, index funds, mutual funds, and ETFs. Understanding these concepts is very important because, like with any investment, you must fully understand what it is you're putting your money into before you commit to the purchase. If you walk away from the video today and you understand everything that we've discussed, then you'll be doing very well for yourself in terms of building up your overall knowledge of the stock market and investing. Feel free to come back to the video at any time and maybe take some notes to reinforce the learning points in your own head. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.